Hello, everyone. Welcome to MedCity News' Invest Conference. My name is Orundhuti Parmar. I'm the editor-in-chief of MedCity News. I will share a few slides describing our company for those that are not aware of what we do. So here we go. So a company was founded in late 2008 to cover innovation in healthcare. We are a national publication drawing nearly 2 million page views monthly. We cover biopharma, digital health, medical devices, diagnostics, as well as hospitals and payers in the context of the industry's overall transformation. We also host conferences focusing on investment, population health, precision medicine, digital health, and patient engagement. And then separately, we also accept contributed content through our MedCity's Influencers program. And then during the pandemic, we launched a podcast called Pivot because we felt that all of us in our personal lives and in our business lives, we pivoted very quickly. For example, this conference is normally held at the Ritz-Carlton in Chicago, and here we are doing it virtually over Zoom. So again, and if you have any interest in suggesting speakers or becoming a speaker for the Pivot podcast, please email me at aparmar@medcitynews.com. I wanted to say a quick thank you to our sponsors, JP Morgan, Unity Point Health, Bioenterprise, and TriNet. This year we had a special content produced with JP Morgan. I had a chance to converse with Pamela Alsworth, who's the managing director and head of VC coverage at JP Morgan. And you can definitely go to MedCity News and check out this conversation. She actually shares very interesting slides on how the pandemic is changing deals and deal making. And then she also has some much needed advice for startups on how to survive this pandemic that we're all facing. A big thank you to MHIN. MHIN is a nonprofit organization comprised of more than 50 active healthcare investment firms with offices throughout Middle America. And then let's talk about what we are here for today. Trends and investment strategies during COVID-19. The moderator will be Dennis Depenbusch, Director of New Ventures Initiative, Blue Cross Blue Shield of Kansas. He also actually leads MHIN. We have 4 speakers: Ambar Bhattacharyya, Managing Director of Maverick Ventures, Dan Gebremedhin, Partner with Flare Capital, Dipa Mehta, VP of Corporate Ventures and Innovation from Advocate Aurora Health in Chicago, and Elise Hoffman, Principal of Life Sciences Fund 1 and 2 at Cultivation Capital. Now I'll go into each of their bios with a little more depth. So Dennis, as I mentioned, is the Director of New Ventures Initiative at BCBS of Kansas. He's responsible for the direction, coordination, evaluation, and management in developing and leading strategic investment. The focus of the initiative is to develop a portfolio of investments that as a whole focus on improving the Kansas and national healthcare market, enhance the core business of the company, and generate revenue. Next is Ambar Bhattacharyya. At Maverick, Ambar has led investments in a number of companies, including Artemis Health, Caribou Biosciences, Centivo, CityBlock Health, Collective Medical Technologies, Concerto Health AI, Devoted Health, Docent Health, Hims and Hers, Homology Medicines, and Notable Health. Prior to joining Maverick, he was a VP at Bessemer Venture Partners. Next is Dan. Dan Gebremedhin is a partner at Flare Capital Partners, where he sits on the board of Somatus, a Flare Capital portfolio company. Dan also serves on Massachusetts Governor Charlie Baker's Board of Nursing Home Administrators. He was a practice internal medicine physician at the Massachusetts General Hospital and had a faculty appointment as instructor in medicine at Harvard Medical School from 2010 until 2019. Next, we have Dipa Mehta. Dipa is the VP of Corporate Ventures and Innovation at Advocate Aurora Health. This is the ninth largest health system in the United States. She focuses her time on fund and direct investments into healthcare companies that are strategically relevant to the provider system. Dipa was formerly a managing director at Sandbox Industries, a Chicago-based venture capital firm, which is the investment manager to the Blue Cross Blue Shield venture funds. And last but not least, we have Elise Hoffman. Elise manages the firm's life sciences funds 1 and 2, and her responsibilities include fund strategy, deal sourcing, due diligence, portfolio management, fundraising, financial reporting, and investor relations. Elise's board service includes serving as a board observer at portfolio companies, Narrative DX and Image Mover MD, and as a director of the Whole Camp Seed Fund at Washington University. So welcome to all of you. The way we are going to conduct this is I will turn over to Dennis, who will conduct the conversation with the four panelists. And then around 20 minutes to the hour, he will open it up for chat, and you can all submit questions through the chat function, and then I will sort of help curate those questions for the panel. So thank you very much for joining this, and Dennis, I will let you start.
Thank you, Arundhati, and thanks to our speakers and for everybody attending today. If it's anything like our prep call, I'm excited to have this group of people together. I would say they are mindful, thoughtful, and accomplished. Before we begin, and thank you for the introduction for all of us, Arundhati, I think we're going to just go around the horn and say what our investment thesis is so that you get an idea of what our perspective is, and then I'll jump into the first question. So, Dennis Depenbusch, I run a corporate venture capital fund. We invest in things like my bio said that improve the health markets in general, are strategic to Blue Cross and Blue Shield of Kansas and provide returns. We currently have 9 investments under management. I'll move over to Elise, and then we'll just go down the track.
Well, good morning, everyone. My name is Elise Miller Hoffman. I'm a principal at Cultivation Capital. Cultivation is a family of venture funds with about 200 million in assets under management based in St. Louis, Missouri. We focus on software IT investments, agriculture technology investments through an entity called the Yield Lab. And then I sit on our life sciences and healthcare side. On the healthcare side, we do invest across life sciences and healthcare. So therapeutics, diagnostics, medical devices, research tools and reagents, as well as digital health, and typically participate in Series A rounds. I would say Midwestern size Series A rounds. That might be a $5 million round where we come in with $1 million first check. Like to serve as a lead investor or a co-lead investor with trusted investment partners, and do have a focus on the Midwest, but also occasionally find ourselves on the coast or other areas like Texas. So happy to be here and have a conversation with everyone today.
Thanks, Elise. Dan?
Thanks, Dennis. Great to be here. So Dan Gebremedhin, I'm a partner at Flare Capital. Flare is a Boston-based venture capital firm. We only invest in healthcare software and services. We've got about just under $500 million under management. We're investing out of our second fund, which is a $255 million fund. I'd say one of the unique things about Flare Capital is that most of our capital was raised from some of the largest healthcare corporations in the country, large national and regional payers, large integrated delivery systems, and then some vertical industry players in the pharma, med device, and lab spaces. We're early stage investors. We're not too prescriptive at the stage that we come in, but I would say about 80% of our deals are in the Series A, Series B stage. Sometimes we'll go earlier in the seed stage, and sometimes we'll go a little bit later in special circumstances. And then with respect to our investment thesis, as I flagged, we're investing in healthcare software and services, but I think our tagline is that we're investing in businesses that are transforming business models in healthcare. So while technology and product is super important, we like to back teams that think more holistically about the healthcare system and are really driving forward business models for a number of stakeholders in the industry.
Thanks, Dan. Ambar?
Hey, thanks again for the introduction. So quickly on Maverick, we're a $400 million venture fund focused predominantly on healthcare IT, healthcare services. We'll still do a little bit of biotech and innovation in and around that, but for the most part, we're early stage investors in anything in digital health. We typically invest in Series A through Series C, but occasionally we'll do seed and help build companies from the ground up, alongside founders and entrepreneurs that are looking to change the world. We're part of a larger organization called Maverick Capital, which is it's about a $10 billion hedge fund, which has been around for 26 years. And so one of the differentiations for us is that we're able to take a lot of that public market DNA and knowledge that our sister fund has, and use it to help inform our portfolio companies in terms of macro trends, in terms of what the larger players in the ecosystem are doing, as well as provide them insights into prospective customers, what the competitive landscape looks like in a pretty differentiated way.
Great, thank you. Deepa.
Hi, Depa Mehta. I lead the corporate venture fund at Advocate Aurora. It's a large nonprofit healthcare system based in both Illinois and Wisconsin. So 26 hospitals across 2 states, serving about 3 million unique patients over the course of a year. And one of the things that really differentiates us as a system is just that we've added those 3 million unique patients. A little over 1 million are in some sort of kind of shared savings or risk program. So we've got one of the largest ACOs in the country and in Advocate Physician Partners, and really see value-based care as kind of what our future looks like going forward. So in terms of fund strategy or investment strategy, I lead 2 different kinds of investments. So do a combination of both fund investing, so investing into other healthcare venture capital and private equity funds, as well as direct investments into companies. So we write check sizes between $500K to 2 to 3 million, only co-investing, so we don't lead deals, and look for companies where we're going to have a longer term strategic alignment with them. And that can come in a number of different forms and factors, and so aren't too prescriptive right now about what that looks like. The investment themes that we look at are really kind of what the strategic areas for us look like going forward. So we have something called Transformation 2025 and have 3 pillars to what that strategy looks like. It's transforming our current core operations, really enhancing what our consumer experience looks like in consumer first, and then creating a larger strategy around whole person health. And 3 categories in whole person health and aging independently, parenthood, and personal performance.
Great, thank you very much. I think we'll just dive right in, and we had a great conversation on this. Aaron Doty sort of kicked it off that says, we live in the world of establishing personal relationships and making in-person visits to determine our investment thesis. Now we're almost all of us on travel ban and not doing those exercises that help us determine and do due diligence on deals. How are we coping with this, and what are each of you doing in your firms to get that diligence done, and are you actually doing deals? So I'll jump first in Dan, because I think, Dan, you mentioned you've already completed one on Zoom, or maybe it was on.
Yeah, we actually just made a small investment in a company called Lumen DX. That was all done virtually, but it's certainly a challenge. I think generally speaking, entrepreneurs, develop a relationship with venture capitalists, not necessarily at a moment in time. It's usually longitudinal over, kind of months, sometimes years. And so oftentimes I think that, we're catching up with entrepreneurs. I think the first part of, kind of the pandemic, the first few months was, call it, kind of disaster management mode, where I don't think a lot of companies were out, raising capital opportunistically. A lot of funds were very focused internally, making sure that their existing portfolio companies were able to kind of manage through the pandemic and reassess, overall, kind of capital allocations. But I think that, the last few months of, that we find ourselves in the pandemic and the quarantine, I think as, kind of the government and the Federal Reserve have kind of jumped in to, stabilize markets, has been quite active for digital health. And so you are seeing a significant number of entrepreneurs coming back out to the market, re-interacting with venture investors. And so, I flagged the one deal that we've done over the pandemic, predominantly over Zoom. And, again, when you think about the work that we're doing, a lot of the work that we do from a diligence perspective is over phone call. And so, Zoom is, virtual meetings are a nice, substitute for that. At the same time, it certainly is a challenge, trying to build relationships, visit companies, in person. But I think as many of our companies have moved to, primarily virtual operations, I don't understand why venture and investors and operations, don't similarly move in that direction.
Great. Commentary, Elise?
Yeah, I would agree with everything that was just said. For us, I think it was a fairly seamless transition into work from home and remote diligence. But that said, the funds that I work on have only done follow-on investments at this point. So obviously relationships have been established and it's much easier to perform diligence in those cases. So it'll be interesting to do the first kind of new deal, with all remote diligence.
Yeah. Ambar, how's Maverick doing?
It's good. I think, we're probably in a similar spot to Dan where, the first few months were chaotic and we're trying to figure out, what's up and what's down. But since then, I think it's been all systems go. We've invested in multiple companies via Zoom only, and I think that process at first seemed like a huge step of how could we possibly do this without ever having met an entrepreneur in person, and I think three things really help with that. One is we did a lot more reference checks, right? I mean, trust is the coin of the realm in the venture entrepreneur relationship. And so, when we invested in these companies, we talked to the co-investors at length who were already on the board. We did, double the amount of CEO references and CFO references, that we normally do to understand this. And we spent a lot of time with the founders over Zoom and over the phone, trying to really understand what makes them tick. I think one of the hardest parts that you don't get over Zoom is understanding the culture of a company. I think that's been really hard. And so the second thing we did was we tried to talk to folks who weren't just at the C level, but we tried to go one level lower than what we typically go to in terms of our interaction. So the VP level, director level, just to understand what the dynamics are, within a company, how decisions are made. And what was on the mind of a lot of the rank and file of these companies. And I think that gave us some differentiated insight that sometimes you get when you walk through the four walls of a company and you kind of see what's on the wall, what's in the coffee room, what's not. There's a lot you can tell there that you don't necessarily get, but you can ask about that culture, like how often what happens at the town halls, how often do you hear communication. That's kind of the second thing. I think the third thing is from a post-investment perspective. I think we tend to be very active investors, sitting on the boards and helping these companies grow. I think what we've done is we've really increased the frequency of our interaction, right? And so what ordinarily might have been a bi-weekly check-in, we're now making it like a weekly check-in, right? Just to make sure that what we've invested in is right. And also more importantly, to continue to build that trust afterwards, right? Being like, hey, we're alongside you. Even if we can't go to the first board meeting in person, we can't visit, here, we're still going to help you find your head of sales. We're still going to help you understand this strategic decision. And I think a lot of those things that used to be done in person, at the dinners before the board meetings or the lunches afterwards, we're trying to really proactively create those situations in which we can do that. And so those are some of the things we've done, and I think so far it's been productive. And I hope some of these habits and patterns will translate into how we invest post this Zoom world, because I do think they're actually helpful in terms of understanding how these companies work.
Got it. Deepa, I think we were both in similar situations as the pandemic hit and then just the recovery period. You might want to talk about that from the corporate venture side.
Yeah, and I think just from a large provider standpoint, right? So, there was a lot of things just going on, obviously, when elective surgeries got shut off and other things from an operations standpoint that happens within a large provider system. So, and then also kind of moving, we've got 70,000 employees, 10,000 of which had to move remote, right? And so how do you help support from an IT standpoint and other kind of toolkits to a lot of those? And so I think that as an organization, there was kind of a, a little bit of a pause to kind of say, let's really address some of our operational and other kind of key issues. And I think we took the time then from a fund perspective to really see kind of where we could be helpful. So our chief strategy officer and a number of others, and even now sit on kind of what our incident command team really looks like, and seeing if there's kind of innovations and entrepreneurs that we're really seeing that could be helpful to our teams right now. So, I think there was that sense of it to say, can we take these strategic insights of kind of what's happening from an entrepreneurial standpoint and bring them into our organizations to help kind of alleviate some of that burden for others as well. And so I think kind of as we go forward, we're still, I think we're kind of back to this place where we're looking at deals. We don't lead deals, right? So we actually, work really closely with a number of different kind of syndicate and co-investment partners to say, what are the ones that could be strategically relevant, and have started a lot of those conversations over the past kind of month or two to really dig into what those companies and what some of our themes really look like. We're still, committed to our strategy going forward, and now it's very much around kind of execution of that strategy for us.
Got it. I think in our prep call, one of us mentioned this new normal that we're looking at with deals has sort of objectified our analysis of these transactions. Does anybody want to comment on that? And I don't know if Ambar brought it up or Dan brought it up during our pre-call.
Yeah, I think I'm happy to take a stab at that. I think what I meant by that is, oftentimes when you're meeting with a company in the ordinary world, there's a lot of subjective things that weigh in. I think the bar has been raised, right, for what actually what kind of investments you want to do, and so you really have a stronger focus on the metrics, the numbers, the product, the early customer interviews, the competitive analysis, and you really have to have a quantitative view on it that has to be very, very thorough. And I like to think that we've done that historically too. But I do think just like because of the absence of the other part of the world, right, where you can't do anything else, it does make you focus on this, and I think it does really. It really does shine, make you sharpen your pencil on, okay, what exactly is happening here? If certain metrics aren't going well, why aren't they going well? If things are going well, like why are they going well? And you start doing these like very, much deeper, levels of questionings here. And I think entrepreneurs are better prepared for it too, right? Because I think they understand that this will be the basis of what will actually lead to a yes. And I think it's been really constructive all the way around, and I think that's what I meant by it's getting a little bit more objective in that it's getting towards metrics, numbers, customer interviews, product features, differentiation, things of that sort that can highlight what the moat will be in the future.
Got it. Anybody else on the panel? Dan, Elise, Deepa?
Yeah, I'll kind of piggyback on that. A lot of great comments, there from Ambar. When you think about this concept of the new normal, when I think about this, we had our annual investor conference in late April, at the height of the kind of the first wave of the pandemic when it was really hitting, kind of the Northeast. And we had to try and predict, how would, the coronavirus pandemic affect our existing investment thesis. And which areas are going to be, kind of hastened and served as catalysts, and which will be kind of held back. And it kind of forced us to kind of go back down to first principles. And, I'll give a plug for, Arundhati's MedCities influencers, kind of program. We actually just wrote an article about, this exercise, and where we thought about where will certain opportunities exist for new companies. And, again, a number of portfolio companies and ours, as well as other portfolios have tried to, kind of build net new capabilities to specifically, kind of service, the kind of pandemic and the economy that we found her in. Whereas other companies were already in that market space. And the areas that I'm talking about are things like virtual care. things like home-based care, things like behavioral health, that because of the new normal of the pandemic that we now find ourselves in, and it seems as though we're going to be in for some time, these areas have gotten a lot of steam. I think the second piece is that I'm of the opinion that, the coronavirus and the pandemic didn't necessarily create new opportunities per se. It really just, kind of catalyzed things that were already there. There were companies that were already in these market spaces. Again, this concept of telehealth. Telehealth has been around, probably for a couple of decades now. But prior to, the environment where, individuals can't go to brick and mortar facilities to get care, telehealth, was seeing relatively low levels of utilization. And there were a number of structural issues with respect to, kind of reimbursement policy and regulatory policy associated with that had to change in order for telehealth utilization to go up 400, 500%. The other thing too, I think, it ties to your first question in regards to the performance of certain companies. There were some companies that weren't necessarily getting a lot of traction before coronavirus and the pandemic and the economic shutdown. And that forced, I think, a lot of entrepreneurs' hands. I think it forced a lot of investors' hands to make a lot of tough decisions. And so I think a lot of companies are evaluating how do you, operate in this new environment where, capital isn't a certainty in order to, kind of fund future growth. And, the customer traction, I think sometimes in certain markets, because of a lot of things that, Deepa mentioned, may dry up in the short term. And so I think that's forced a lot of companies, investors to reevaluate the new normal.
Great. Elise? Deepa?
Yeah, when I think about the new normal, I too am thinking about it in terms of, our investment thesis. And we just fundamentally believe that healthcare delivery has changed and will remain changed as a result of the pandemic. And so, on the healthcare side, we're particularly interested in those companies that either, have a product that is incredibly relevant now, whether that's remote care or telemedicine, or have actually pivoted to create a new, COVID-19 application that addresses some of those pressing problems that have been exposed during the pandemic. So some of the things, I'm watching there beyond just kind of the remote patient monitoring and telemedicine space are also how are, hospital systems more effectively delivering care? How are they, meeting the new needs they have to triage patients effectively, to minimize, patient and provider interaction, and to think about creating, disease-free environments so they don't become a hotspot for corona, while, all the while managing, new staffing needs and trying to think about how to navigate that. Another piece that I think is really interesting is around creating infrastructure, both for this pandemic and also, for future epidemics, which unfortunately we know are more frequent, probably going to happen in our lifetime. So thinking through, companies that have advanced modeling around supply chain management, population health tracking, some of those things that are critical now, but can also help us better prepare for the future.
Got it. What's Advocate's position, Deepa, on the new future of healthcare delivery?
Yeah, and I would say it's everything that everybody talked about, right? I think that the thing that we're also, that I'll just kind of add on to a little bit is this idea of, how to deliver this care, right? And so I think that, telehealth, again, we saw this, huge increase in adoption, obviously from us as a system. And then as physicians, started using it within our system and our medical groups even more often as well. And I think now in our minds, it's not just the adoption, but it's the optimization, right? So how do you really optimize that level of care? And could you, and not only from a scheduling perspective, but also from how do you give the right tools to the physician to be able to kind of have, tough conversations over telehealth, and, deliver news that, that they were traditionally doing from a bedside and doing it now over video, right? And so I think that there's a lot of things that we're thinking about, even from an education perspective, for our physicians to really be able to think about how to create your telehealth bedside manner, right? And really be able to get the same effectiveness that they would get kind of in some of that in-person care, and be able to do that over telehealth too. So I definitely think that for us, it's, adoption is going to be key, at least for this year and next year, and then we'll be very much around optimization for a number of things.
Fabulous. Thank you. Well, there's one new normal that we probably need to bring up, and we did during our last conversation with great perspective, which is diversity and inclusion. Here we are in a very exclusive group of individuals in the venture capital side, and what are we doing to face up to the realities? And I'm pleased to be the only white male on this presentation. We have two individuals of Indian descent, one from Ethiopia, and two women. So there's actually boxes checked here. So I'm excited to hear your perspective, like we had last time. I might start with Dan and then move to Ambar, and then finish with the last two women, because there was a big undercurrent or initiative years earlier on including women into the venture community, and how have we done there, and what are we going to do to face up to our realities?
Yeah, no, I appreciate you bringing it up, Dennis. Again, I think we are sitting in a society right now that is having a very broad kind of national conversation, and appropriately so. And, it's unfortunate, the circumstances that led to this conversation, but, at the end of the day, I'm glad that it's happening. I think, in, kind of professional settings, as you've kind of described, there are a lot of underrepresented groups, both from an ethnicity perspective, but then also from a gender perspective. And so, I think there's a number of studies that have shown that having, kind of people of diverse backgrounds around the table making business decisions make better decisions, right? I think a lot of studies have shown that because you are taking a look at, a particular situation from a number of perspectives, right? Which leads to, I think, better outcomes. The second piece, though, too, is when we think about the industry that we're in, healthcare, right? We are also serving a very diverse population. And again, I think of my first investment out of the Flair Fund, which is a company called Somatis, which is focused on delivering kidney care to populations struggling with chronic kidney disease and end-stage renal disease. The founder, as well as a number of the members of the management team, is from an underrepresented background. The founder is of African descent. But when you look at the population that Somatis serves, patients who struggle with end-stage renal disease and chronic kidney disease oftentimes come from, socioeconomically disadvantaged backgrounds, ethnically, underserved backgrounds. And so it's super important, I think, as we build out management teams and solutions, that they kind of represent the populations that they're serving, because ultimately that's how you're going to get the best outcomes, the best perspectives around the table. And then again, take it a step further. You might argue that you want to have people of diverse backgrounds on the investment teams to make those types of investments. But at the same time, I think as we're having this national conversation, I think there's a lot of people who can participate. You don't necessarily have to be from an underrepresented background to be an advocate and to advocate for change.
Thanks. Ambar?
Yeah, those are some great thoughts. Let me just add on a couple additional things. So one is there's this idiom that you manage what you measure, right? And so one of the first things we've started to do, and we have done historically, is we're now tracking both for our portfolio companies on a board level as well as a management team level diversity statistics. Gender, racial backgrounds, things of that sort. Because if you don't actually know what they are, it's very hard to improve it. So we have a baseline. We're not perfect yet, but we're improving. If you look at it year over year, quarter over quarter, it is improving on all those metrics. And our hope is to have that be, it's extremely diverse. Right? That's the goal. The second thing I'll say is, I'll give an example of one of our own portfolio companies and what they've done. honestly since inception, this company called CityBlock, which focuses on treating Medicaid populations using primary care, whether at home or in a clinic. But one of the things that they have done extremely well is in the board decks, they talk about every level of the organization. So, the social workers, the middle management, the executives, and the board, and they highlight, what percentage of the staff is diverse, both on a racial background as well as on a gender background. And so we're actually able to see that at a board level. And I can tell you, like, most companies don't do that. And as a board member, you don't have that insight into what that organization looks like. And I think it allows us to have a conversation here about, okay, where are we good? Where are we bad? How do we improve? And importantly, like, how do you think about the career path for someone, right? As they move up the organization, how do we make sure that those career paths are enabled, that they have the mentorship necessary to move up the ranks. I think the last thing is that, there are, like, as Dan mentioned, it's a tricky time, caused by really unfortunate situations. But I do think there's a lot more conversations happening about this, and I think that has made us all more sensitive to the topic and more focused on the topic. And I do hope that when we're sitting here a year from now, we'll not only see improvements in terms of the actual statistics, but also how we think about it and how we approach it. And so I do feel like there's a reason for real optimism and hope on this topic at this moment.
Great. Elise?
Yeah, so systems are designed to create the results that they produce. And if we want to be intentional about diversity, equity, and inclusion in venture capital, I think we do have to take a look at institutionalized racism within systems. And the economic and political systems in this country have for generations concentrated wealth and power in white hands, and traditionally kept people of color and women out of industries like VC and like tech. And so I think it's important to move forward, to acknowledge this historical context, but also not use it as an excuse for inaction. It's important because venture capitalists have decision-making authority about which innovations move forward, and the funding decisions have long-term impacts on the technologies that the broader US population uses every day. So if we look at healthcare venture capital, biases of the small group of investors that do make these decisions can be reflected in which diseases get research funding and which don't, since there is an inherent value judgment in which problems are prioritized for solving. So I would just encourage us as this healthcare innovation community, as we are responding to a pandemic that has disproportionately impacted Black and Brown individuals in our country, to include the voices of Black investors and Black entrepreneurs in the conversation as we navigate this crisis. I do agree one of the initial steps that firms can take is to track diversity metrics. So how many entrepreneurs of color are at the top of the funnel, make it to the pitch to the partners, ultimately receive investment, how many Black investment associates, principals, and partners are on our teams, how many Black limited partners, and historically Black colleges and universities have invested in our funds. These are KPIs that if we're not tracking already, we should be, to understand our baseline and to understand our progress over time. One of the things that's interesting is just that venture capital is such a network-driven industry, and a lot of times people's networks tend to look like themselves. So if I, as a white investor, look around and the entrepreneurs in my network look like me, rather than saying, this is a pipeline problem, I think it's my responsibility to take the personal and institutional action to broaden my network. I think it's important to consider that many of the spaces that we as white investors may inhabit are predominantly white spaces that may not be inherently welcoming to entrepreneurs of color. And I think it's important that we take the initiative to attend conferences targeting women and people of color, and to also continue building relationships with funds that do publicly have a gender equity lens, a racial equity lens, because these organizations are aiming to be intentionally inclusive. And it's incumbent upon all of our firms to try to be more, intentionally inclusive. And that may take more work on the front end, but doing this work, I believe, will generate higher returns. And so the venture capital industry, an industry in which Black investors make up 2% of partners and 1% of funded entrepreneurs, we as an industry have an opportunity right now to participate in the national dialogue. And we can do that by working to advance racial equity within our own firms. In the innovation community, we pride ourselves on disrupting systems that are not working. And so I want us to do the work to disrupt racism in venture capital, even and especially when we find it in ourselves and we find it in our own institutions.
Thanks, Elise. Deepa.
I agree. I mean, I agree with what everybody said. I think the only additional lens that I would just add is, I think one of the really interesting parts of my role that I wasn't really doing before was really kind of this limited partner role. And I think it's, incumbent also upon kind of where limited partners are coming from to really kind of build some of these kind of, diverse pipelines of talent that happen in any of the commitments that they're looking for going forward. So I think that, when some of these kind of, conversations are being had and other things are actually being talked about, I think that having those conversations with your GPs and with others is a really important one to have to help kind of start that process, even kind of within VC, and then hopefully that kind of flows back down to the entrepreneurs that are being funded as well. And so I definitely think that there's a commitment that you make both from a GP perspective to the entrepreneurs you're funding, and then from LPs to GPs to have a very similar mindset as well. Great.
Thanks. We're at a quarter past the hour, and I'm encouraging people to send some questions in if you have it, or if any of our panelists have any additional thoughts on any of the things that we've discussed thus far.
I'm actually a little curious, so I'll pose a question first to you, Dennis, and see if other folks want to chime in. So I'm not sure whether you attended our pitch track yesterday, but there was a very entertaining presentation, but I'm not sure whether that's the right tack that entrepreneurs should be pursuing. So I wanted to ask you first, Dennis, and then, like I said, others can chime in. So this was a company that made, it was a medical devices track yesterday. So the company's core business is making feeding tubes for folks in the hospital. But the entire presentation was on how they've pivoted to making face shields for adults and children. And they're getting huge number of orders, their revenue is up exponentially, but it seemed like that they were not looking at their core product at all. So A, is it smart to go after shiny new objects as an entrepreneur and make hay while the sun shines? Or is it, or maybe you can take revenue from that and focus on your core products? So what should people do that have the ability to pivot in this way right now?
That's a loaded question. So congratulations on the company, because any pivot that earns, exponential revenue, I'm in favor of. So if they pivoted into that space and they can do it, that's great. I don't know where the feeding tube market is because I don't follow it. And if this is a longer lead time and that subsidizes them to that outcome, that's great. Or maybe it's something they need to abandon and just stay in face shields for the rest of their term. It's hard to determine. I can think of 2 portfolio companies that did the shiny object thing, but they also had really good core businesses, and it was really incumbent on the CEOs to come to the board and say, hey, we have this really neat pivot that's going to do a return to work program for employees. I think we should chase this down. And really have to analyze, well, does that enhance or take away from a core business that's already earning you money?
Okay. Does anyone else want to address that?
Yeah, I might jump in with some kind of examples. I'd flagged it earlier, and Deepa mentioned it as well, that once the pandemic hit, many enterprises, in particular health systems, number one, from a mind share perspective, but then also from a capital perspective, couldn't afford to think about anything else than coronavirus. And therefore, and I would even say, a lot of health plans as well, even though they're not, exclusively focused on, delivering care, they had to shift a lot of resources to managing, the pandemic. And I think that if you had otherwise been selling to these large, kind of healthcare systems or health plans with a product that, kind of wasn't in demand, you're going to hear crickets, right? And so I think that's why you've seen across the industry. And again, I think people who, are on social media, probably saw for the first, month or two, every company talking about how that they were responding to the pandemic. It would be hard to stay in business. We have a couple of portfolio companies, Aetion and Health Verity, that work in the real world evidence space. Prior to the pandemic, they really weren't spending a lot of time in and around infectious disease. And I would argue that, probably after, a few weeks when they started to kind of see government agencies, specifically the FDA, asking for this information, they had to, kind of spend a lot of time, effort, and energy. And it took several weeks, but now they actually have a contract with the FDA where they're actually delivering this real-time information from health systems in regards to how, different organizations are actually treating patients with coronavirus that the FDA is then using in their own real-world evidence trials, to determine efficacy of these treatments. So it's super important. The second piece I would say in regards to this concept, I think a broader question is about a pivot. And you mentioned feeding tubes, which I think is an interesting one. It's not uncommon that companies will start with a lead product, and in the process of marketing or trying to drive adoption of that lead product, they'll learn something about the target market that they were going after, and they may find adjacent opportunities. And I would say that's not uncommon, where companies start to kind of slowly evolve and pivot. You might argue that feeding tube to face shield is a bit divergent, and it's not as adjacent. But I would encourage startups to iterate on their product offerings as they learn more about the behavior of their end users and their customers.
Great, thanks, Dan. There's a question from the audience. I'm going to direct it to you, Elise, assuming I can pronounce all of these words correctly. What are investors' thoughts on the search for novel and superior technologies in the virus sampling space, solutions beyond nasal, nasopharyngeal, and saliva commodity approaches?
Yeah, I don't have too much to add on that topic. I may yield my time to someone with more expertise in that area. One of the things we've been really focused on right now are digital health tools during the pandemic. So I'll just mention just a bit about that in relation to the last question, which is that, when you have a tool that may have a COVID-19 application, like one of our portfolio companies, Orbita, is in the voice first and chatbot space. They have been able to make incredible traction with hospital systems for their COVID-19 chatbot. However, that's kind of the beginning of a conversation for them and an opportunity for them to work with those healthcare systems, to use that chatbot functionality in many different ways. So I'll yield my time on that last question, but just wanted to mention that while there is this commercial willingness in particular to adopt digital health tools, it's a great way for companies to kind of get their foot in the door and then land and expand, after the pandemic subsides with a more holistic platform.
Got it. I will pass this next question to Ambar. How does this year, being an election year, affect, if at all, each person's investment strategy?
It's a great question. Ordinarily, in an election year, I think there's a lot of reticence around healthcare because tends to be in the political crosshairs of either the Democrats, the Republicans, drug pricing, future of Medicare, all sorts of stuff here. I think 2020 is a pretty unique year where, because of the pandemic, everyone is focused on healthcare as the savior of what can actually get us out of this moment in time. And so what you're not seeing so far is the media focused on, pharma drug pricing. What you're not focused on right now are reimbursement cuts on how to make, Medicare more sustainable in the long term. Even in the last few months since Biden got the presumption nomination, you haven't heard too much about Medicare for all. So a lot of these major topics that could be disruptive to the worldview of a healthcare investor on a relatively short-term basis are now, for the most part, as of mid-July, they're non-factors, from the most part. And so this seems like an ordinary year. And so the way that we've been thinking about it is much more, okay, this is, it's all systems similar to what it was before, with the added tailwinds of telemedicine, how do we actually reach people who are vulnerable and in needs, and that being part of the public dialogue a little bit more than usual. And I think a lot more of the questions are, more nuanced, but they're all additives to the pie, i.e., will telemedicine reimbursement continue at parity, or will it be at some sort of discount to an in-person visit? Will telephonic visits continue at the same rate as before or not? And how will the system reimburse for that? Is there truly an ROI for a telemedicine consult versus an inpatient consult, and how our commercial payers think about it? These are all interesting, nuanced questions that one would think about regardless of the election year. And I think that's what makes this a very, very unique time that I don't think has kept any investors on the sidelines right now. I think it's been a positive.
I'll direct the next question to Dipa. You have all mentioned the interest in a holistic approach. Would you be interested in digital health platforms that were originally developed in other markets where they have more of a holistic approach to transforming the US healthcare system?
Yeah, and I would say yes. And I think that the reason for that is because, I think there's two kind of approaches to it, right? Or there are two elements to it. It's the solution itself, but then it's the payment model, right? And so I think for a number of either health systems or others, the payment model has typically been kind of the barrier around kind of adoption around certain kind of new technologies. And so I think a lot of the companies that are kind of emerging and doing really well right now is that they've got a novel solution, but then also adopted a payment model around it. And so if you look at kind of health systems and others that are the ones that actually own, risk on certain patients, I think that there's kind of a more openness towards these kind of models that you see either in other countries or even that are a little bit more outside of the box, because the payment model is kind of aligned in a way where they want to adopt these things. And so I definitely have seen kind of an increase of those types of things, or those types of companies that are coming into the US markets and who they're actually targeting from a customer standpoint over the past year or two as some of these payment models are being aligned.
I'll direct this question to anyone on the panel. The question is, do you believe that adoption of COVID-related testing protocols will usher in a next generation population health management solutions for employers? If so, is that a re-emerging area of investment interest for any of you guys?
I might jump in because it actually pertains to a recent investment that I made during the time of COVID. We invested in a company called Eden Health, which is doing virtual and near-site, on-site primary care for employers. And we made the investment kind of back in February, more around this concept of employer health, and that employers are going to be playing a larger role in the care of their employees and not delegating it to insurance carriers, TPAs, third-party brokers, benefits consultants, and the like. But in March, once the pandemic really hit, the number one thing on the mind of employers was COVID and the safety of their employed populations. And I would argue that by and large, it was due to the lack of a response, a lack of federal response, and a lack of, kind of local regulatory response around how to best manage the care and the safety of employees. And so, Eden is in this process now where they're helping employers kind of figure out what is their strategy around managing COVID, making sure that, employees, if they have to work on site and they are essential employees, they're not risking other populations. And implicit in that is testing, right? And so, Eden isn't doing testing on their own. They're working with, other laboratory companies, both big and small, to deliver tests to employed populations, kind of at a distance. But, they're also using that opportunity to teach their employers that this is a virtual primary care platform and you can use it for other things. It doesn't just have to be COVID. And so I think the question is quite insightful, that right now employers care more about the health of their employees than ever before. And you have this, kind of moment, right? There's that quote, you never want to waste a crisis, right? Where you can actually also show them that you can get virtual care longitudinally, not just focused on COVID alone, although that is the number one reason why a lot of employers are buying today.
And I'll start with you, Dennis, on this one. And then I would like each of you to address this as sort of our final question. Everyone's warning of a recession, a big recession. We're seeing the stock market sort of hold steady, but then we saw unemployment numbers tick up for the first time in 4 weeks. So for each of you, is there one or couple of metrics that you are looking at to start to begin thinking that, yes, something bad is about to happen?
Yeah. Oh, yeah, Dennis, go ahead, sorry.
Okay, I think we underwrite that risk into the equation, and whether or not that particular technology or solution is going to survive that recessionary pressure. So, it could be how you price the deal, but it could also be in terms of the macroeconomic environment. If things hit a recession, is it a recession proof or a recession? Is it going to be impacted by the recession because of that? So I think that conversation is implicit and usually done on this, not only on the individual firm level, but at a syndicate level too, and sometimes debated.
Okay.
So,
Ambar, you want to go next?
Yeah, sorry, I forgot you called that Dennis there. I'll say there's there's one metric we look at across our B2B portfolio companies on this, which is the velocity of new pipeline added, to sales. What tends to happen in healthcare is that the sales cycles are long, right? They're 4, 6, 9, 12, even 18 months long sometimes. And so in order for you to know what your Q4 2020 numbers are, Q2 2021 numbers are, you need to be adding a healthy amount to the pipeline, 6, 12 months in advance. And so one thing that we're tracking across the board is, in Q2 and now in early Q3, how fast are we adding to the top of the funnel? Because if that velocity is decreasing on a quarter by quarter basis, that could be a leading indicator that we are actually tipping into a recessionary mindset, even if we're not quite in a recession yet. And the needs of these customers are changing, and they're tightening their belts. And so that's the one thing we look at. So far, I'll say, we have not seen that across the board, for our portfolio companies, and the pipeline does seem to be, continuing, does seem to be, healthy across the board, which we're thankful for across both the pharma, payer, employer, and provider space. Providers probably in that order, where they're still, the most, the most in the COVID moment. But that's the single metric we look at.
Elise?
Yeah, it's kind of an interesting question. I was having a conversation with an investor the other day, and we were kind of talking about how, when you had the .com bubble, that was, one economic recession. When you had the 2008, that was kind of a real estate crisis. And now, we're really in a healthcare crisis. So while there have been healthcare companies that have obviously struggled during this time due to delayed clinical trials, vendors not being allowed in hospitals, that period of time where there was just rampant cancellation of all elective surgeries, it is also a critical time for those companies that do have innovative products that are either addressing COVID-19 directly or helping healthcare providers better serve non-COVID-19 patients that have a unique moment to excel. And so it's interesting overall, some of the valuations have been going up. I see in my work, we do have more kind of flat equity rounds and warrant coverage and kind of more investor-friendly terms just to reflect, the market conditions and the uncertainty. But that said, I do think there is an opportunity for many of our healthcare innovation companies to excel right now, despite the overarching, uncertain economic environment.
Deepa?
Yeah, I would say that, again, being a corporate venture capitalist, it changes your view because, we take a really kind of long-term view of kind of what this is going to look like for the companies that we're investing in, as well as, some of the strategic relationships that we're building too. So I think that it depends, again, I think it could depend on the timing, but I think it could also depend on kind of the life cycle of the fund, and when some of these investments from a stage perspective could be made and how much something from like a holistic economic standpoint could affect some of these companies. And so, so I think it's a little bit different from a CVC standpoint. And Dennis, I don't know if you're seeing some of the same things, but that's at least, and I think again, being a nonprofit kind of healthcare system and being kind of one of the larger ones too, I think having kind of access to capital and being able to still kind of be able to still kind of invest in innovation and really be able to kind of move the ball forward, kind of going forward, it helps to manage some of that risk for us in the future too. Dan?
Yeah, no, and I might tie it back to the earlier question in regards to, making investments in healthcare, in an election year, right? I think, there are certain aspects of the healthcare, industry that are recession-proof, and then some that are not, right? I think there's certain aspects of the healthcare industry that are, very subject to regulation risk and regulatory risk, and some that are not, right? And so I think, I would take a sector-by-sector approach to determine, the likelihood of success of a potential investment. On the other end, I can, to Deepa's point in regards to, the lifeblood of a venture capital firm is being able to find investors who invest in the fund, right? And, during recessionary cycles, you can imagine it can be harder to raise capital. And so that's, I think, at the highest level, you have to also kind of consider that as you are deploying a fund and thinking about going back out to raise.
So I know we're 5-6 minutes past the hour, but I did want to add one last question, and I'll stay with you, Dan, for that, and everyone else can answer. How has the pandemic affected valuation and deal structure?
Yeah, no, it's a fair question, and I'd say there are two answers to that, right? Again, we talked a little bit about the first 2 to 3 months of the quarantine and the pandemic, and the economic kind of slowdown. I think valuations were quite challenged. I think you saw a lot of companies, adding to last rounds, doing bridge rounds at investor-friendly terms. I think the second half of the pandemic, and I think the height of digital health that has essentially emerged. I think valuations in many cases are just as high as they've ever been, if not higher, because there are I think certain investors, either who are already investors in healthcare or had not yet made investments in healthcare, identified that they had, kind of target areas that they did not have exposure to, and were willing to, kind of bid up, as it were, for deals in, let's say, virtual care, behavioral health, home-based care. And you see these companies raising extremely large rounds at very attractive valuations. And so I think it's like a tale of two periods that we're seeing in the healthcare market right now.
Dennis?
Yeah, I agree. You had the follow-on rounds that ended up being at par at the beginning of this pandemic. If they were raising money, their terms were turned around in that first 3 months. Now, I'm seeing deals that were at the same valuation as January, or maybe even better. So I think activity has picked up, and that pause has, I think, created a bubble of capital that is interested in transactions. And so that's holding those valuations and terms back at January 2020 levels.
Ambar.
Yeah, I'll say the biggest difference about 2020 from a valuation perspective versus the last 10 years is that before, if we'd be having this panel in 2016, the question would be, could there ever be a venture-backed company in digital health that reaches $1 billion of market cap, right? And we'd all say, Athena made it there, but it took, 15 years, and there's a few other companies that touched it. And, that would be the main question is, can there ever be a $1 billion company? And you look now and, Livongo's at 11 billion, Teladoc's close to 20 billion, and the questions are now is, hey, can this be a $10 billion company? And soon I think it'll be, hey, can this be a $100 billion company? I think these questions were ones that we never asked before. They were so far from, from the minds of folks in the venture community. But now that you see multiple touch points, and that's excluding Vivo, which is, 25, 30 billion of market cap at this point in time, you're starting to see these really interesting companies and these entrepreneurs dreaming bigger. And I think as there are more proof points for that, you're starting to see the valuations accordingly go up as well. And so, notwithstanding the recessionary points that we talked about before, I do think that there is this desire of entrepreneurs to build these long, huge, lasting companies, and venture investors are willing to believe it. And I think that those have been, really important changes in the market.
Great. Elise?
Yeah, I would echo what everyone has said. Really for the companies that have struggled to advance during the pandemic, you are seeing extended bridge notes and flat equity rounds. And then for the companies that have, been able to persevere and actually, have increased revenue growth, or maybe have a specific COVID-19 application that's bringing some revenue in the door, some increased valuations there. So it just depends. But overall, what I'm seeing is, a lot of flat rounds for now.
And finally, Dipa.
Yeah, I would echo a lot of the things that Ambar was just talking about. I think that traditionally, when you look at healthcare IT, a lot of it from an exit perspective was strategic. And so those multiples and those exits weren't, always the largest exits, right? So as a venture investor, you were kind of pricing off of, a $200 million exit or a $300 million exit, depending on kind of where that company was and kind of what, if it was a services company versus an IT company. And so I think that, having that ability to go to the public markets has really changed the way investors are really looking at companies and really thinking kind of big about what some of these exits could really look like, and being able to get that kind of, home run that you're looking for when you're making an investment too.
Great. Well, I wanted to thank each and every one of you for taking the time to talk to us and doing another Zoom session. I know there's Zoom fatigue sort of creeping in, but I appreciate you taking the time.